On this morning's Ag Issues program, a pleasure as always to bring on to the program Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine, thank you.
Well, let's get into our topic, and we're talking about House Bill 5376. People know it as the Build Back Better Act that was passed on November 19th on a 220 to 213 vote. And you just dropped an article on your blog this morning to talk about this, but specifically some of the tax provisions that are in 5376. And maybe we should say some of these selected tax provisions that are in 5376, but we also have to look at some of the tax provisions, tax proposals that are not in the Build Back Better Act, too.
Yeah, this could have been far worse, frankly, in my view, than it actually came out of the House, because there were things that had been proposed, and of course I've been speaking on this for over a year, talking about these issues and how to plan for them if they occur, and a lot of them didn't make it in, and so I think we can be thankful for that. And so the things that didn't make it were an increase in the corporate tax rate to 26.5%, so that stays at 21%. They didn't change the basis step-up rule at death, so we get fair market value at death basis in the hands of recipients of property from the decedent's estate, and so they didn't fiddle with that. That was a major concern for farmers and ranchers across the country. If we lose the basis step-up at death, that affects every single estate out there, not just the higher valued estate. So that one didn't make it in. They did not increase the top individual rate to 39.6%, so we stay at the top end of 37%. They did not increase the top capital gain rate to 25%, so that stays at 20%. Plus, if you have passive gains, it goes to 23.8. So no change on that. They didn't change the qualified business income deduction. That's that QBI deduction, a 20% deduction for sole proprietors and pass-through entities that came with the Tax Cuts and Jobs Act. So that didn't change. Of course, the amount that's passed through from an ag co-op doesn't change, so farmers still get that. They didn't change and this is the other major piece that's out there that they didn't change, they didn't reduce the federal estate tax exemption. So we still get basis step up, and we still get the $11.7 million exemption equivalent of the unified credit this year, which now will go to $12.06 million for deaths and gifts made next year. They didn't change the rules surrounding grantor trusts. So our irrevocable life insurance trusts, our GRATs, our dynasty trust, those rules didn't change. Frankly, I'm shocked that didn't happen on the House side, but they didn't change that. They didn't change the present interest annual gift tax exclusion either, so we can still make present interest gifts to as many donees as we have funds, $15,000 per donee this year. That goes to $16,000 per donee next year. And they didn't increase the top federal estate tax rate. That stays at 40%. They also didn't fiddle around with what we call the valuation rule, so we can still claim minority interest discounts, lack of marketability discounts on entity interests that are gifted during life or passed at death. And so no change there. And the other thing that you and I have talked about in the past, because the federal estate tax exemption did not come down, they did not increase the maximum amount of reduction in value of agricultural land that's included in the decedent's estate under a special use valuation election. They didn't have to increase that. So all of these are not in there. Which is a relief. And I tell you, I went back through this thing and looked several times and made sure I was looking at the last version, because they did make changes right up to the last minute. And it's really hard when you're looking at several thousand pages to make sure you're looking at the actual version that they passed. And so the article that I posted this morning, there may be tweaks to that coming, because I may find that they switched an effective date on me, or they switched a code section. It's really hard to figure out exactly what was passed, but I'm sure those pieces are not in there.
Now, let's look at some of the individual provisions that are in there as well. What are some of the things that farmers and ranchers need to keep an eye on, specifically looking at individual provisions?
Okay, so we started with the good news. Now this is the not so good news. Well, some of the big ones there, and this is good or bad. It's actually a tax increase followed by a tax cut. It's kind of weird the way this works, but the cap on state and local deduction for taxes, itemized deduction on the return. So if you've got, if you live in a high property tax state, for example, or you have multiple homes, you're taking a lot of mortgage interest deduction, or you have a lot of real estate taxes. And, this is a big issue for farmers and ranchers, can be too. So your state and local tax deduction on the Schedule A is big. Well, the Tax Cuts and Jobs Act, starting in 2018, limited that to $10,000. What this bill does is take that to $80,000 on a married filing joint return, half of that if you're married filing separately or it's an estate or a trust. Now, this is effective for tax years after December 31, 2020, so that would be in effect for 21 and before 31. So it's 10 years, and then in 2031, the cap's going to go to 10,000. Then there'd be no cap for the later years. Now, the interesting thing on that increases the limit. And under current law, it's $10,000 through 2025. And if they don't change the law, then the $10,000 cap comes off starting in 2026. So now we have more that you could take through 2025, and then less than you could take starting in 2026. So it's kind of weird the way that one works. But that's a big issue for some people on that state and local tax deduction. And that's a big one that's in there.
What about, there is some modification to the child tax credit, or the rules for concerning the child tax credit and advance payments?
Yeah, and some of these would take effect this year. They could be retroactive back to the beginning of the year. And one of the things that they put in there is full refundability of the child tax credit, meaning if you don't have a tax obligation, then you get the credit, then the government pays you the amount of the credit. And so it's fully refundable if you have a principal place of abode in the U.S. for more than half of the year. They also increased the age limit of the qualifying child to those not having reached age 18. So you can get it up from, instead of 17, up to 18, and then increase the amount of the credit, $3,000 and $3,600 for a qualifying child not having reached age 6. Now recently, because of the virus-related legislation, they kind of split the child tax credit into two. You have children under age 6, and then another credit for children over age 6 and below 17. So they've enhanced the credit, increased the 17 to 18, and then modified the phase-out ranges so it'll apply to more people. So I would say that's an expansion of the child tax credit.
But there are also some things looking a little further down the road concerning Pell Grants and some other things as well.
Yeah, Pell Grants under this bill that are not used for qualified tuition and related expenses can be excluded from gross income. And then the amount of your education credit, such as the American Opportunity Tax Credit or the Lifetime Learning Credit, is not reduced by any Pell Grant amount. Now, I don't have any data, I didn't look for any data to indicate how extensively used the Pell Grant system is. So I can't tell you how useful or not useful that is. But for those that are receiving Pell Grants, if they're not used for qualified tuition and related expenses, they can be excluded from gross income.
Now, also looking at, the adjusted gross income, looking at that, and dependent on where your modified assisted gross income lies as far as the numbers say, if it exceeds $10 million.
Yeah, this is a provision they put in there specifically for farm radio broadcasters, and that's a surcharge of 5% once your modified adjusted gross income exceeds $10 million on a married filing joint return, and then it's $3 million in addition to that once it gets over $25 million. So, Greg, you're going to have to do some planning to keep your income below those thresholds.
All right, we'll get that going here right now, as a matter of fact, as well. What about eligibility for the premium assistance tax credit?
A further expansion of this one. This is that credit under Obamacare to help pay for health insurance, the higher cost of health insurance that the law created, and extended through 2025 is eligibility for that credit for individuals and families that have household income over 400% of the federal poverty level. That used to be the threshold. That came off a bit with the virus-related legislation, and now that's been extended. Plus, this provision extends through 2025 the repeal of indexing of the individual or household share of premiums used in determining the premium assistance credit. So that's going to mean that more people with higher incomes can qualify for a credit to offset the cost of their purchase of health insurance through any of the Obamacare exchanges.
We have been looking at some of the selected tax provisions of House Bill 5376 and their economic implications. That is better known, by the way, as the Build Back Better Act that passed the House of Representatives on November 19th, still awaiting the Senate. Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is joining us. And Roger, we've been looking at individual provisions, but let's look at some of the business provisions as well. One is concerning limiting the deduction of business interest expense applied to the limitation at the partner level rather than at the entity level.
Yeah, this one is actually huge, and I'm somewhat surprised at what I sensed was the lack of response, particularly from the cattle feedlot industry. In the TCJA, the Tax Cuts and Jobs Act, which went into effect in 2018, there was discussion leading up to that of putting in a limitation on the deduction of business interest. That got the cattle feeding industry all upset because if you understand how the cattle feeding industry operates from an economic standpoint, they are highly leveraged and they pay a lot of interest and they need to deduct that interest. Well, they succeeded, and I was part of a group. They succeeded in their lobbying effort, and I was part of a group that helped to draft an exemption, the $25 million exemption on the limitation of deducting business interest. All right, what they did this time was to say, okay, you've got that limitation in there, but we're going to remove that limitation from the partnership level, and we're going to apply it through the entity level to the partner. So that what that means is that the exemption will not apply with respect to the entity. It's going to apply down at the partner level. So if what you've got here is a limitation on the deduction of business interest to apply the limitation at the partner level rather than the entity level so that exemption under 163J of the code doesn't apply with respect to a partner's allocable share, whatever flows through, of business interest or expense items from the partnership that fails to meet the gross receipts test to qualify as a small business. I wonder about that one surviving in the Senate. We'll have to see because the disallowed business interest expense under the provision can be carried forward indefinitely, but we'd like to use that currently. We'll have to keep an eye on that one just to see what happens.
Another one is expanding the net investment income tax created under Obamacare to apply to trade or business income specifically for taxpayers and depending on if you're filing jointly or filing as a single file.
Yeah, and this one, Greg, is going to wipe out basically the use of S corporations where your income is above $400,000. What this is, the net investment income tax, is that passive tax, that 3.8% additional tax on passive sources of income as a result of Obamacare. Well, we avoid that to the extent that we have active business interests in entities as well as sole proprietorships. It's a passive type tax. So if I have cash rental income, that's passive income. If I have investment interest, that's passive income, so forth and so on. If I create an S corporation and I pay myself a salary to avoid self-employment tax on probably half of the salary. So let's say I'm a farmer. I'm generating $500,000 a year from grain sales, those types of things, or even $1 million or $2 million. I pay myself a salary, say about half of the Social Security wage base, plunk that in, say about $72,000, $75,000 a year. That's my reasonable compensation. I'm going to be safe from an IRS audit on that. But everything else that I generate comes to me by virtue of a draw from my S corporation, or if I have a partnership, I have a guaranteed wage, and the rest is a flow through from the partnership. Well, we don't pay the NIIT, this passive tax on that. Well, here, if you have taxable income exceeding $400,000 for a single person, $500,000 on a married filing joint return, then that passive tax is going to apply to your passive income. It will not apply to wages on which FICA is already imposed, but everything else now becomes subject to this additional 3.8% tax. Really, I think that if that goes through, that's going to limit our use of S corporations for a lot of clients.
One I want to get to before we run out of time, the reinstating of the corporate alternative minimum tax.
Yep, this came off with the Tax Cuts and Jobs Act. They would put it back on. It would be a 15% minimum tax on corporations if they have adjusted financial statement income exceeding $1 billion. So once you get, this is for the large corporations, $1 billion the threshold, you're going to pay a minimum amount of tax of 15%.
And we got time for one more, but you've got energy IRA provisions plus other provisions as well. One thing, like you said, it still faces the Senate, so to be determined how many changes or how many things they add, how many things they drop, whatever happens when it gets to the Senate.
Yeah, and I'll say the same thing that I said when I closed out a major farm conference in Iowa City, Iowa this past June, and that is pay attention to what President Manchin says. And I said that deliberately then. I say it deliberately now because the ball is in his court along with Kristen Sinema in the Senate. If they don't agree with this stuff, then this goes nowhere.
All right. And if people want to read the full article, Roger, what's the way they can reach your blog?
They can go to my website, washburnlaw.edu/Walter, WALTR, and on the left side on the homepage, you'll find a link to the blog, and it'll be the blog posted this morning. And there may be changes, and I'll keep this updated as we get more information that comes out of the Senate.
All right, sounds good. Roger, as always, appreciated. We'll talk to you here in a couple of weeks.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the Ag Issues program here on 580 WIBW.